I handed out this page. I'm not sure I have one for everybody, so if you need to share, that would be kind of cool. I've got to kind of want to talk about a lot of things. The problem with being a financial advisor sometimes is people pigeonhole themselves. Maybe they're strictly stockbrokers. Maybe they strictly sell annuities. Maybe they're more heavily life insurance. There are just so many things about one's financial future and plan, and it's never a one-size-fits-all. So one thing that I wanted to talk about, it was a little of all of those things. I am series licensed, and we do have money under management. I'm part of a team that has about 125 million under management, so it's very nimble as compared to a multi-billion-dollar institution. There are tremendous advantages with that. So if you're talking about managed money, let's just start there. Kathleen talked about Walmart today. You know, the market is a fickle place sometimes. Sometimes the financial indicators of housing and retail, etc., the interest rates, the Fed's decisions, all of those are major factors in driving the market, but not always. More often than not, maybe not more often than not, but often enough, it can be guys flying planes into a building out of the blue. It can be the government decides to take on one company, Microsoft, and causes a massive tech fallout that was a huge drop in 2000. And then that didn't end because 9/11. So that was a 2-year crash in the market, both of which perhaps were avoidable. 2008, we had, everybody knows about the real estate crisis, triggered by, you know, principally one company, but many others, AIG, trading in subprime loans that should have never been given out. And so there's just so many things about the market that you'll just have to scratch your head and go, I don't get it. But in general, what you're looking at with this sheet right here, the red line is the S&P 500. So if you had $100,000 in 1998, we're caught up to 2015. That $100,000, if it was in the S&P, would be $183,000. Now that doesn't sound like a lot. It's not bad. It is stair-stepping in the right direction. The market does go up. It does go down. It has its good runs. It has its black swan days. But in general, it over time has risen and continues to do so, and I think it will continue to do so. Although the Fed is not showing a lot of confidence in the market. When they don't raise the interest rates at all, what they're basically saying is we don't have confidence that the market really is turning around. That's at least what I'm told. It is really just a big fat who knows sometimes. But money under management, here's the deal. If you have money under management with the big institutions, that's great. But most often, you're in a buy and hold philosophy. When you're in mutual funds and those types of funds, you're typically in a buy and hold. Now, if you're 35 years old, buy and hold's not a bad idea. If you're 65 or 70, buy and hold, and you're about ready to take income, or you're already taking income off of your retirement dollars, buy and hold might not be a good idea for all your money, or a majority of your money. I just met a gal day before yesterday. She has roughly about $500,000, all of it in the market. She's 70 years old, and she pays her taxes and takes half her income off of it. And I said, well, okay. I said, if the market was going up 6, 7, 8% every single year, then you could theoretically take out 6, 7, 8% every year, and protect your principal, and you'd probably be okay. Anybody have an idea of what is published out there right now as fail-safe for what percentage you can take on your money to keep you from running out of money if your money is in the market? Anybody have an idea? Okay. Traditionally, they're saying 4%. Then there was a big publication out that said 2.8%, and the most recent is 2%.
So none.
None.
Yeah.
Right.
And you protect your principal.
Well, and that may or may not completely protect your principal. Remember,
Right.
if it's 2000 and 2001, I actually have a friend who retired early 2000 in the insurance business. I know him really well. He was 60 years old. He'd done really well. He had quite a lot of money in the market. He had a lot of dividend stocks. He had a lot of income. He had his home pretty much paid down, et cetera, et cetera, et cetera. And this is going to sound, I think I've even mentioned this guy before, but it's just going to sound like a bad movie script. But he's literally in Tibet for 3 weeks helping Habitat for Humanity. And in that 3-week period, the market crashed. And no one had power of attorney on his account or directive. And so they couldn't get him on the sidelines. He lost almost 80% of his value. Now, that wouldn't have happened if he was home. He might have lost 30 or 40% because eventually you get out. Hopefully, unless of course they're telling you you're in a buy and hold, don't worry about it, it'll bounce back. He's retired.
Yeah.
Can you say, well, no problem, I'll wait for 6 or 7 years? By the way, when the market crashes, it generally takes a good 5 years to bounce back. Now, people will talk about those 5 or 6 years, like what we've had in the last 5 or 6, since 2008, 2009, as these are the good times again, because we're making money, and from 2002 to 2008, 2007 were really good years. From late 94 to 2000 were really, really good years, an amazing stretch. The problem is, if you had a crystal ball and you knew when to buy and when to sell, this would be really easy. That's almost never the case. Matter of fact, more often than not, people sell when it's down and buy when it's high, ironically enough. Okay, we're all probably guilty of that. However, there is much more potential long term, and it is the better inflation fighter, the market. It does fluctuate. You can go from conservative to aggressive. You can actually pick out individual stocks and just ride them, and sometimes that can be a really good idea. It's generally fully liquid, and you have more potential. So there are really positive things about the market. That some of the negatives is, as I said, sometimes you can't get your money out in time when the market crashes or there's a black swan event, like planes into a building. Or an announcement that AIG owes $80 billion and they don't have it. You know, I mean, literally, Walmart just talking about the fact their earnings aren't going to be as high, if at all. And thank you. And
no,
is that
not time?
Oh,
How much the Walton family lost yesterday?
oh, how much?
$9 billion.
You know, if I lost $9 billion off my $200 billion, I'd be really mad.
I thought you were going to say that instead.
You know, but when those types of things happen, you know, you realize that this is a volatile world, and my opinion is we're going to be in a low interest rate environment for many years to come. And so people are always worried about inflation. Well, deflation can also be a problem. So, you know, I'm sure there's very few of us here that would prefer their house to be worth less 10 years from now than it is today. Now, fortunately, real estate has also proven over time to be a great investment in your portfolio. I love real estate, but just going out and leveraging real estate can also be a really bad idea. So again, it's all about diversity and balance. But if you're going to have money under management and you're going to have it done through, a major institution, the things you need to concern yourself with aren't just the fees, aren't just the commissions. They could be load stocks. They can have internal fees. Most funds have their own expenses. Usually what they're publishing is the basic fees. But if you dig a little deeper, for example, that gal I was talking about that has about 500,000, all of it's in the market, she says, well, I pay 1.5% in fees, and we charge between 1.3 and 1.7 on the money under management. But then we showed her that she had a full another percent in other expenses in her account they didn't tell her about. So she's literally almost a full percent higher than us. Now, you think, well, just 1%, that's not a big deal. No, it's a big deal. That could be as much as 15, 20% of your actual profit that year. And that's if you do profit. Okay? And if you don't, that's an anchor. So fees and commissions to all of us is a part of the industry, and you have to factor in if you're going to gain on your money. So we're very, very conscious of what it costs to manage your money. The other issue with money under management is what I was telling you about buy and hold. We believe in a much more tactical approach. We'd like to be able to get out within minutes if it's possible and get you on the sidelines. Now, so even sometimes that is not possible. So there's always risk when your money's in the market. Well, I really go the conservative route. So my financial planner has said I should be really conservative. Okay, and so I feel really good about that. Well, at the turn of the century, a lot of really conservative mutual funds had Enron in them. Okay, a utility, safe, they're cooking the books. They brought down a lot of funds, things. Look, conservative sometimes can be worse. Sometimes those funds can actually be worse. If you look at this sheet, now, opposite of managed money, typically for most portfolios on the retirement side, is fixed instruments like the indexed annuities, which I'm also a big fan of. Not for all your money and not for everybody. It depends on the circumstances. But just FYI, if results are what matters to you, regardless of what you read on the internet about stocks, about bonds, about annuities, your money's tied up, they have lots of fees and charges, you wouldn't want that, and blah, 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 blah. There's a lot of truth to a lot of things, but if results are what matters, just check out what American Equities, well, they have a 5-year plan they've just canceled because it was paying too well, but their 5-year plan over the last 15 years, okay? That same $100,000 would be worth $214,960. That's better than the S&P 500 performed. And by the way, just FYI, most mutual funds don't reach the S&P benchmark. Okay? So if you think you're in a great mutual fund, maybe you are, I don't know. But again, if results are what matters, sometimes the fixed annuities, particularly for long-term money, while my money's tied up, what else are you going to do with it? And by the way, does anybody want to untie their income? I'd really like to tie up as much income as possible when I retire. So, because income is king. It's great to have your house paid off, but you can't eat the walls. Okay? It's just an asset. And so what most people are forced to do is to sell that asset, downsize, and take the money as a balance to live on. And that becomes their largest asset. The number one asset is, for most people? Social Security. That's the number one asset for most people. Okay? And and that's a good thing. And for most of us in this room, Chris notwithstanding, Social Security would probably be okay. High road notwithstanding. Because we're sitting on most of the money and we're the biggest voting bloc. So I think we're probably going to be okay. Our children, maybe not so much. You know, they believe that if they don't make any changes, Social Security could be out of money by 2035. So that's Social Security charts.
It's not too late for you guys to have more kids, Ron.
Yeah.
More children.
There you go. Do I got time for questions or am I toast?
More children.
I'm done. All right. Thank you very much.